Mackenzie Smith, staff writer at Risk Magazine. I'm here interviewing Eddy Sternberg at Loomis, Sayles Company. Eddy, first question for you. The rate hike this year is fairly well advertised to be in September or December. What impact do you think that'll have on currencies this year?
We've already had some huge impact since the end of last year or middle of last year. Many of the currencies, especially EM currencies, which is what I look at, have depreciated substantially, in many cases 20%. But in general, 10 to 15%. And so it all depends on what the statement that comes together with the rate hike will say. But if we see a moderate path or pace in the increase of rates in the United States, the downside for currencies may be somewhat limited. Now, however, if the statement indicates that this will be a fast-paced rate hike cycle, we will see more downside.
And foreign exchange has always been known as one of the most liquid markets in the world, but liquidity has been brought into question this year. Do you see that as an issue if there is a rate hike and its effect on emerging markets being able to move out of positions?
Not so much on the currency side. That shouldn't be a problem. It is always a problem on the instrument side, whether it's an equity or more likely on a bond. Liquidity does get strained in those occasions. I would also say that not so much on the liquidity side, but on the central bank intervention side, where we may see either some kind of limit on flows, or maybe not so much limits, but certainly some intervention from central banks in making or ensuring that flows are smooth and that there is no panic. We've seen that in the past. We've seen some regulations, maybe some taxes. Brazil had them on the way in. Maybe they'll put them on the way out. They've had them in the past. Mm-hmm. So that could be if things become abrupt or really panicky.
So emerging market currencies have been often viewed in a basket against the dollar since the crisis. Do you see individual currencies now separating out from those baskets compared to perhaps what it used to be?
I don't think we can put all emerging markets in one basket because they don't all behave the same way. Some definitely do separate. Some are behave better in times of risk aversion or are more of a safety type currency, especially the Asian currencies. As we know, the Middle Eastern currencies are all pegged to the dollar, so any investment there will be quite, I would say, uncorrelated to currency moves. Likewise, in Asia, those as long as they're not high-yielding, dangerous investments like maybe the China property market, but in general they tend to stay quite more stable than investments in Latin America and Europe. So I don't know whether we can just put them all in a basket, and that's how it would separate them. And also, it's not just a regional story, it is also a type of savings type of story, in the sense that the current account balance is what counts as if it's positive as a saving country, or if it's negative as a not saving country. And so Asia again tends to be in Asia, countries tend to be saving countries. In Latin America, they tend to have negative current account balances, except for a very short period in the early noughts. But I would say that's where you will see more of the sell-off again, Latin America, from that perspective.
Once the rate hike comes about, is there maybe one or two emerging market currencies that actually might do quite well out of that? Or are they all doomed to suffer?
Well, some are uncorrelated, but those are more the frontier market currencies. In a way, you have to think that the Mexican peso, even though it is a bellwether for emerging markets, it sells off, even though fundamentally it shouldn't. Maybe after a couple of rate hikes, people will see it as very positive for the United States in the sense that the U.S. economy is doing well and it warrants the rate hikes and it's to protect from inflation. That in itself is very positive for Mexico because Mexico is very integrated into the United States economy. It means, and we're already seeing that, it means that Mexico is going to continue growing well, and it may mean more investments into Mexico. Plus, Mexico has a lot of other changes, structural changes going on for itself, and that will in itself bring money into the country. Again, that would be positive. In addition to remittances from workers, Mexican workers in the United States, tourism, when we feel good, we travel and we spend money, and that would be Mexico's a very close country and very good tourism country.
Okay, all right.